welcome back to the channel. Very special guest with me today, Troy Cates from NEOS. And Troy, you're actually not only a portfolio manager, but a co-founder of NEOS, which is a relatively new firm. And today we're going to talk about SPYI, all about that ETF. So welcome to the channel, my friend. And how have you been? How are you doing today?
Doing great. Thanks for having me. Excited to talk to all the folks listening in about SPYI and talk to them about NEOS ETFs.
Yeah, I'm excited as well. The ETF is making a splash in my community, which is all about income-oriented investing. Any new covered call ETF, especially a nice S&P 500 one, gets my attention. So before we delve into that or dive into that, tell me a little bit about NEOS yourself, because NEOS is relatively a new firm, but you guys are definitely not new. So tell me all about yourself and NEOS.
No, I appreciate you asking. So NEOS has been around for a little over a year. We launched our first funds, SPYI, CSHI, and BNDI in August of 22, so just about 10 months ago. But the team at NEOS has been involved in the ETF space for well over a decade. I personally have been in the financial sector for over 25 years, spending a good part of the beginning of my career on the market making side for options and ETFs, and really focusing on the equity and option parts, and then moving over to the asset management side probably about a decade ago. And our team was part of a different team than is here now, but my co-founding partner Garrett and I were part of a team that built out some of the early option-based ETFs in the market, funds that are still out there that still have billions in AUM that have been out for 10 plus years, but more thinking about back then, these were all passively managed funds at the money buy rights. But we were some of the first option-based ETFs out in the marketplace. We eventually sold that business in 2017 and moved on to a different firm, a different asset management firm, where we had brought out a number of ETFs as a sub-advisor, and went more into the active space, and still work with some large insurance companies on those active ETFs. And we just realized, my partner and I realized we want to bring this team back together, this team that we've worked with for so long, and start NEOS and really get out some really good income producing products. So we launched with the suite of our first three ETFs. We wanted an equity one in SPYI, we wanted a fixed income one in BNDI, and we wanted a cash alt one with CSHI. So all income producing monthly distributions, looking at different parts of your portfolio and really where can these three ETFs slot into almost most people, most advisors, most individual investors, where could it fit into their portfolio and really provide them some income at the same time.
Okay, excellent. Thanks for your background. So you're definitely experienced, right? It's not like you're a new covered call manager. You definitely have experience. And yeah, you do have three ETFs. So we're gonna, the SPYI one is the one we're gonna focus on. That's the equity one. You have a bond one, a fixed income one, and then you have a cash one. We're going to talk about SPYI today. That's what I'm really interested in, growing very rapidly. So tell me a little bit about the premise behind it. What's the objective of SPYI? You kind of already touched base that you're looking to be more of an active manager instead of a passive manager. I found that SPYI, I watched that little video, which pretty much explains it really well. Tell me all about SPYI.
So SPYI, we wanted to get an equity product out in the marketplace that could participate with most of the upside of the S&P 500, while at the same time providing a high monthly income. And the goal was to be able to build an option portfolio that overlaid onto the S&P 500 that could distribute anywhere from 10 to 12% a year. That was kind of our goal when we were building this option portfolio. And to kind of get into the guts of it, the long equity holdings were long the 500 plus names of the S&P 500, where in the same way we rebalance when they rebalance, add, delete, and so forth. So we're not trying to pick individual names or trying to fundamentally look at the names of the S&P 500 and pick our best ones. We're just tracking the S&P 500 on the equity side. But our expertise really comes in the option portfolio management. So basically, as you were saying earlier, we have we're using the call side of the option chain, and we're using that and selling calls to bring in premium that we can have to use for the distribution. So on a monthly basis, we're selling out of the money calls, and everything we do here at NEOS is model driven. So this is a systematic rules-based model. I'm not just picking random strikes when we're selling the calls at the end of the month. We have a model that we look at that's been tested and that we're following and tracking. The portfolio managers review it. We send it to our trading desk and they execute. But on a monthly basis, we're selling calls out of the money. And on average, they're anywhere from 1 to 4% out of the money. We sell them usually in a laddered structure. We're not selling one call. It's usually multiple strikes. And the goal is to bring in enough premium to support that distribution. And when you add in call it 1% or so a year that the S&P 500 kicks off from the underlying equity holdings, plus what we bring in from that premium, we get to this where we are now. We're distributing just about 1% a month for that 12% yearly distribution. The nice part about what our model does is we don't need to necessarily sell on 100% of the notional of the portfolio. On average, we're anywhere from 75% to 90% covered on the portfolio. So that leaves a good portion of your portfolio that is not capped by the short calls. So if you think about it, if you're writing 1 to 4% out of the money, you still have some upside room in that portfolio throughout the month. But if you're also not writing on a good portion of the portfolio, 15, 20% of the portfolio, that portion of the portfolio can move higher without the short calls on top of it. So as you've probably seen and looked at our performance over the past few months, we've captured a good chunk of the upside of the S&P 500, and the product's been really able to perform in this marketplace.
Seems like you guys found a magic formula. I mean, the holy grail of covered call writing. Covered call writing is an art. The holy grail is, can you beat the underlying with the covered calls? It's almost impossible, especially in rising markets. And that's what really caught the attention of SPYI. You have it right there on your website. If you compare the performance to the S&P 500, you're actually beating it, which is pretty much the holy grail of all investing managers. So my next question was going to actually be about the covered call strategy, but you detailed it beautifully there. As we know, there's two factors: moneyness and coverage. You've covered both, so you're covering almost all the portfolio. I figured it was going to be 100 or close to it, and you're pretty much 75 to 90, I think you said. So you're covering most of it, which means the other portion, even though it's a small portion, just does what the S&P 500 does. And this is really an S&P 500 ETF, unlike a competitor like JEPI. I know you can't talk about it, but I can. JEPI doesn't actually have, I talked about in the review video, by the way, JEPI doesn't have the S&P 500. A lot of people don't know that. They have about 100 stocks inside of that. You guys literally have, like you said, you're not trying to pick and choose stocks. It's the S&P 500 with rebalancing, 75 to 90% coverage. That is high, but they're out of the money calls. And my question was going to be, how out of the money? You answered that 1 to 4%, right? So okay, so I get the cover call strategy. One thing I really want to ask you about is even in that video, you said that it's sometimes, I can't remember what the word is, but at certain times, a portion of that distribution that, from those call options can be used to purchase out of the money SPX call options. So can you explain? I get that will capture more S&P 500. If it goes up, that it's a good thing to buy a call, right? If something goes up, that's what you want. So can you explain how you decide, when you decide to do this, you decide not to do this? Is it part of your system, or tell me a little bit about
so that. It is part of our model. And think about it like this, where volatility is currently right now, right around, you're looking at the VIX at 13.
Low,
as volatility gets compressed,
yeah,
and you're bringing in less premium from those
right.
short calls out of the money, our model could possibly switch and say, let's write one call, say, I'm just putting it out there, 1% out of the money, bring in enough premium and take a portion of that premium and buy a further out of the money call. So we might have some participation if the market does move higher, whether it's in the call spread portfolio or the current portfolio, which is just the laddered short call portfolio. We're still trying to bring in enough premium on a monthly basis to fill that 10 to 12% distribution, yearly distribution. So either way, that's how the portfolio works. But as vol gets compressed, we get to levels we haven't seen in a while, a 10 or 11 VIX, and we're really compressed on volatility. That's when it might switch to that call spread portfolio versus just the short calls.
Very interesting. So this is really actively managed call option, writing and things like that. And I think you guys found a really right formula. What I've noticed right away and things that are really important for us income investors is their monthly distributions do vary, but they're actually very, very close. That's very close to 1% a month, like you said, which is awesome. Translates to about, like you said, you're estimating 10 to 12% a year. Right now, you're, I think, a little under 12%, which is very, very high, especially for a fund that does not use leverage. Correct me if I'm wrong. There's no leverage
Correct.
here at all.
No leverage. Correct.
No leverage. Pretty good management fee as well. 68 basis points, I think it was. So very low management fee. So I think you guys got a winner. You have a really cool formula. So next question I want to ask you, and this is a comment I've been seeing on my ETF review video, is regarding the taxes on the distributions. I think a big portion of the distributions are ROC, or return of capital. I've talked about this a million times on my channel. I think that when people say, ROC is just your money coming back to you, there's a lot more to it than that. It's not necessarily the case. Can you talk about that? Because there's actually a little blurb or a line on your website that says something about taxes, that they're going to be tax efficient. And I'm not an expert on the US side. So tell me about the distributions, how they're taxed and things like that.
So I'll start with what we're using in the portfolio. We use SPX index options. SPX index options and all index options get a preferential treatment from the IRS, which is called Rule 1256. And on your gains, you're taxed at a 60% long-term, 40% short-term for capital gains, which is a big advantage, tax advantage, versus if we were using ETF options or, equity-linked notes or swaps, or if we were using something along, individual name, selling Apple calls or something like that. So index options get this really nice tax treatment, no matter the holding period. If we hold it for 1 day or 1 year, you get that 60-40% long-term, short-term on capital gains. So that's something that we wanted to put in the portfolio from day one. Outside of index options are very liquid. They're more liquid than most of the ETF or any other options out there. So we prefer to trade the index options. On the return of capital side, yes, this is something that comes up a lot. I think people kind of revert back 10, 20 years ago to owning some kind of closed-end fund that yielded 7%, and all they did was get their money back over the years, and it never appreciated. So in a product like SPYI or any real buy right strategy out in the marketplace that's in an ETF structure, which you have, ETFs are the most tax efficient wrapper to use in a fund like this. When the tax folks kind of dive into where did your distributions, you made monthly distributions all year, where did they come from? If the market's moving higher and your underlying equities are moving higher, that short call portfolio, inherently, you're probably losing money on, even though you're bringing premium in to support the distribution.
Right.
Coming from somewhere. So is it coming from your long equity portfolio? Is it coming from your short call portfolio? Where is the actual distribution being categorized, and what is the net P&L of the underlying portfolio? So if you have this portfolio that moves higher over the year, and your underlying equities are higher and the market's higher overall, you might still have a return of capital, which is maybe what some of the comments you're seeing are. And people don't understand. They say, am I just getting my money back? And it's no, you're getting a more tax efficient distribution. Yes, your cost basis on where you purchased the underlying ETF will move lower over time as you have more of a return of capital. But that just means that when you maybe decide to sell it later down the road, you should most likely be in a more tax advantage position because you're selling further away. Whereas if you were just getting your dividends and paying ordinary income on that every year, you would be taxed at the highest rate versus being taxed at a more efficient rate if part of that is categorized as return of capital. So it's something you could consider a constructive return of capital. Your NAV went higher, but your distributions weren't taxed as high because it was considered partially a return of capital.
It's a win-win, right? It's a win-win. The way I look at it, and this is how I try to explain it to most newer investors who don't understand this concept of return of capital. It's just a tax classification. It's not just your money coming back to you. A lot of people think, oh,
Yeah,
it's just a Ponzi scheme. It's completely ridiculous. Your fund manager is trying to make your distributions as tax efficient as possible for you.
correct.
And the way I look at ROC, and like you said, it lowers your cost base so that if you would sell SPYI later on, it's capital gains, which is very, very tax efficient. This is
Yes.
why when I see ROC, I literally just consider it capital gains. Personally, that's how my opinion. That's how I see it. It falls under the same umbrella. I actually say I think of it as delayed capital gains if and when you sell it. That's how I
Yes.
see ROC. So thanks for your explanation. I hope that's sufficient enough for the audience. I know I had to go through that a million times because typically high yield funds, a big portion is return of capital. That's actually a good thing as long as
Mhm.
the NAV is staying relatively high, and if your total returns, they don't lie. Not only is your NAV going up, but they're very tax efficient distribution. So two last questions. Who would you say this ETF is designed for? What kind of investor would you say SPYI is perfect for?
I think it's perfect for anybody looking for income, but still wants to take that equity risk in the market. They don't want to look and shovel money into fixed income or T-bills or something like that. They really want to take equity risk and try to capture part of that equity upside, but still have that income coming in on a monthly basis. We talk to a lot of advisors. We talk to a lot of individuals that own the product, and they're really just looking for income, but they still want to be in the market. They don't want to walk away from the market. And it fits in a lot of different. I know people and advisors that use it for clients in their 30s because they want that equity risk, but they're still trying to get a little bit of income into their portfolio. But I know advisors that push it into their clients' portfolios even later in their 70s because they're still okay taking that equity risk. So I think it's anybody who wants to participate in the equity markets, but still get income at the same time.
I think that's a great way of putting it, right? You're still investing in the S&P 500 and your strategy, you're capturing the upside, you're getting a lot of income as well. And I always think of whenever you add a covered call strategy, it's more of a defensive strategy. You lower your risk, you lower your volatility. And a lot of people tell me, well, why don't you just buy the SPY or VOO? I say, well, listen, you could just get SPYI and just turn the drip on, and bang, you turned your income strategy into growth strategy with compound interest. That's how I look at it. Of course, I'm a 100% income oriented investor. So Troy, thanks very much for coming on. Really appreciate it. I hope you come back again. I'm looking forward to new products. And of course, I know you can't really answer this question, but I always have to do this. When is NDXI coming out? When
Okay.
is the NASDAQ version coming out,
The
or maybe a
NASDAQ
Russell
version.
2000 version coming out?
Well, I can't comment, but the question has come up a lot,
Okay.
and I think there is interest there for the product, and there's some other products in the marketplace that use the Nasdaq 100.
Yeah.
So it's something we're looking at.
Excellent. Good enough for me. And we'll look forward to your new products. So keep an eye on it. And congrats on your success and so far amazingly winning strategy with SPYI. So hope to see you again.
Thank you.
Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.